The U.S. national debt. It is so big that it's kind of hard to relate. Back in 1994, it was $4.7 trillion. Fast forward 30 years, it is, well, $36 trillion. It's kind of like a family with a household income of $50,000 having a credit card debt of $330,000. Makes you think that even if the Trump tax cuts are extended, sooner or later, those taxes are going to have to go up. So what kind of planning with that in mind can we do now to take advantage of lower rates?
Yeah, extremely scary where we sit at as a country, with our national debt over $36 trillion. If you break those numbers down and you look at it, that's $271,324 per taxpayer, ultimately to cover those national debts. Now, if you take that and you extend that even further and you look at the debt per citizen, so again, not all people are taxpayers in the U.S. Some people are youth, as an example, but you spread that burden between every citizen in the United States. That's $106,763 in taxes that every citizen would have to pay. So they really have to get that under control. And Chris, what I would say to you is, I would say first and foremost, tax planning seems to me to be kind of a buzzword. It's a buzzword, I think, that a lot of financial advisors or insurance professionals talk about, but they don't really have the specifics on how to help somebody out in their situation to take advantage of lower tax rates. So what I want to do is I want to get really specific in what we do for our listeners and our clients in what is called the Retirement Team Action Plan. So in the Retirement Team Action Plan, we talk about the 4 different items: taxes, estate planning, asset protection, and money management. So in looking at the tax planning part of it, the one thing that I would tell you to do is always consult the advice of your accountant or CPA before you make any tax changes. But that's where we love working hand in hand with a client's CPA or accountant, or making an introduction to somebody and ultimately going through the tax savers checklist. I'll give you an example of somebody who recently came in from one of the workshops that we did. We'll call them Terry and Karen. In their situation, what we were able to do is we were able to go through the tax savers checklist and identify some very specific areas to help them take advantage of potentially lowering the tax rates. An example of that is they had a lot of money that was shown up on taxable reportable income on their tax return. And being higher income earners, they could benefit from potentially switching money over into tax-free municipal bonds would be one of the items that we picked up on the tax savers checklist. The second one is we looked at tax-efficient required minimum distribution withdrawal strategies. So in their situation, Terry and Karen were over the age of 73. They're taking required minimum distributions, and quite frankly, they're just putting that money into their bank account. They're then philanthropic. They like their church, and they like one of the local universities. And so they donate a decent amount of money to their church and a local university. Well, by looking at it, again, going through the tax savers checklist, we were able to point out the strategy to be able to take and donate your required minimum distributions directly to the charity. And by doing so, can help satisfy the required minimum distribution rules, but also be able to keep that income off of their tax returns. And then the third thing is it's kind of like this snowball effect. So when you have less reportable income, you could have lower Medicare premiums. There's a test for Medicare called IRMA that determines the amount that you pay for Medicare. And it's like a 2-year look back that they do. But ultimately, the cost that you pay for Medicare can double, sometimes triple, if your income level gets too high. Yet by having less reportable income, again, shifting those required minimum distributions could be another way that they would have lower Medicare premiums by not having that income as taxable. And then the last thing we looked at is they had a carry forward loss. They had met an advisor years ago in the past. Unfortunately, his hot stock tips turned out to be big losers. And then ultimately on their tax return, they were carry forward this large amount of losses, only being able to write off about $3,000 a year. But looking at their portfolio, when they got a new advisor, they had some nice unrealized gains on a couple of the different positions in their portfolio. What they can do is they can lock in some of the profits and use that to help offset some of those carry forward losses as well. This strategy alone for Terry and Karen, by investing just a little bit of an hour of their time and going through the tax savers checklist, could potentially save them thousands of dollars in taxes, immediately impacting their taxes for now. In the tax savers checklist, we also start to do and create a roadmap for you. So in looking at the roadmap, we look at what the future looks like. So in Terry and Karen's example, it's highly likely that they're probably going to pass wealth on to the next generation. They're not even already spending their RMDs. And some of the investment assets that they have, like their traditional retirement accounts, ultimately are not the most tax efficient way to transfer wealth onto somebody else. And so by showing them that, we were able to look at tax saving strategies for today using the 25-point checklist on our tax savers checklist, going over creating a tax roadmap that ultimately could create a legacy that could be substantially bigger than just delaying what this ticking tax time bomb is. So I know, Dave, you also work with a lot of clients and develop the retirement team action plan and look at tax saving ideas as well. What kind of planning are you advising people to look for?
I think the one area where we could have a discussion with just about any client is that if you're needing to take RMDs, but you don't need the money, maybe you should be thinking about doing some Roth conversions. By doing a Roth conversion, you can position money for a tax-free distribution to a beneficiary. I would say that even just earmarking these Roth IRAs for your loved ones or for a charity, that's a good way to position some assets. So you can do conversions over a number of years and try to move more and more of your money from where it's all going to be taxable to where it's going to be income tax free to your loved ones or to yourself if you choose to take it later on. But I will tell you that carried forward loss topic is a very important one to consider, because I know people that had enough carried forward losses from 2008 to be able to, they're carrying forward for the foreseeable future. So this has been a very good year for the stock market. So you should be taking a look at where you've made your money, how much carried forward loss you're bringing into the 2024 tax year, and try to wash some of those losses off, because that would certainly be one way to really keep your income below that threshold where everything snowballs on you, especially with the Medicare premiums.
If you're hearing all this and it sounds almost akin to a second language out there, let's try to boil it down to simpler terms. There are ways out there to take advantage of the tax code as it is right now. President Trump has said so much that he wants to extend these tax rates as they are for the foreseeable future, but that just gives you more time to do this. Pay less in the bigger picture towards Uncle Sam. With Black Friday in the rearview mirror, a lot of people, spent time camped outside of their stores to save, a couple $100 or $50 or whatever on this or that. We're talking about potentially saving thousands of dollars on your taxes, and it just starts with doing that tax savers checklist. About an hour of your time could be some invaluable time. All it takes to get started to begin that retirement team action plan. Setting up a time to speak with the Retirement Guys formula. 419-794-3030 is how you go about doing that. Once again, 419-794-3030, or you can go to the website, schedule a time right there at arhq.com.